Now here is Ticky Fullerton on Your Money.
Yes, hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally. And we've got some big results out today. Now, on my watch, not on my watch rather, Willox, AI Group CEO, is adamant that unions will not control wages hikes by pulling the strings in the powerful industry super sector. But pressure on companies to shift on global emissions is another matter. Our interview on super for good and business expectations ahead of the election coming up. NextDC shares slump post results. Are investors disappointed, or is it just the wrath of the short sellers? Leo Shanahan speaks with NextDC CEO Craig Scroggie a little later in the show. And how does the insurance industry pick itself up after the worst disruption since the FAI scandal? Royal Commission, natural disasters and new standards. Well, Insurance Council Australia Chair Richard Enthoven joins me live to share the takeouts from his annual conference today. And of course, we'll have that big announcement on Rio Tinto results just dropping soon. Well, some big numbers out on super this week from the regulator APRA, the December quarter superannuation performance, and they speak volumes about the fallout from Hayne and where people have shifted their nest eggs. Over 12 months, the entire super industry's $2.7 trillion worth saw a 1.3% increase in total assets over the year, although in the last quarter there's been a small pullback. The clear winners, though, industry super, and in particular the big daddy of the industry funds, Australian super. The losers, well, the retail funds. But it's where these funds choose to put their investments that is the talk of the boardroom at the moment. This week's announcement by Glencore that it would be freezing production levels of coal was the result of affirmative action by this Climate Action 100+ group of investment funds, including 3 industry funds from Australia, First State Super, Host Plus and Aussie Super. Here's First State Super CEO Deanne Stewart.
If you actually can have a broader group that provides a good framework, which is what climate action provides, for companies like Glencore, for example, showing more transparency, reporting on their climate change and thinking about what actions they are taking to reduce their impact and imprint of carbon over time.
Now, also in recent days, we've seen action by the MUA and the ACTU, which are furious about the sacking of 80 workers on board, or the laying off of 80 workers on board of one of BHP's iron ore freighters. The backdrop to this is a huge ding-dong about the uncompetitive costs of Australian cabotage and what the right employment conditions should be. Well, here's BlueScope CEO Mark Wasella this week, who's looking as far as Vale in South America as one option to supply his iron ore for the East Coast Port Kembla Steelworks to replace BHP. Now, he didn't want to be drawn into the union pressure at all.
We have no control. So if we were to buy raw material from a supplier, it's really not up to us to tell the supplier who to use to ship it to us. In the scale of things, we're a tiny consumer of iron ore globally.
The unions are clearly agitating through their representatives on industry super boards. The ACTU, Sally McManus, wants industry super to pressure corporate boards of companies in which they have highly influential investments to force those businesses to put up wages. It's a vexed issue because wages growth is terrible. Costs in the home for big items like utilities have been going up. But equally, this is interference at a new level and flies in the face, one would think, of Justice Hayne's recommendations around trustees putting the members' interests first, which, as of this month, has a civil penalty attached to it. Now, that goes to the returns that the fund makes, and that goes to the returns that the business makes that they're investing in. Whether you look at politics or the boardroom, these two really vexing issues, climate change and low wages, are always rising to the surface. AI Group CEO Willox has some pretty strong views on where the line should be drawn, on how investment money should influence the boardroom. We talked a short time ago, and I asked him first, given the Royal Commission fallout and the upcoming budget and the election, what was front of mind for his business members right now?
And I think there's more downside risk than upside risk, and that's what members are reporting. There's a lot of businesses doing it very tough out there. A range of factors. Drought is still having an impact on the economy as a whole. The fallout of the Banking Royal Commission has made things tough on a couple of fronts. One on housing, residential construction and residential loans on one level, and the second level is business loans. Very tight. Businesses are reporting. There's obviously some concern about the election, both in federally and in New South Wales, which is our biggest state. They're both having an impact, so that's an issue. And then there's international factors like the US-China trade war. Nobody wins out of a trade war. They're just there to be endured. And the concern that our members are seeing is, well, what happens in terms of impact on other countries like Australia?
Yeah.
The US and China are our two biggest trading partners, so how do we get hit? And then Brexit is the great unknown out there that nobody can predict. So you put all of that together, the short-term outlook is not great, and businesses are trying to get through it. So far, on the whole, getting through okay, but we're seeing some real signs of stress across parts of the economy that we've been reporting for a few months now, and some of the data, official data, is starting to reflect that.
OK, so just picking up on one thing that you talked about there, and that is that the tightening of credit. Where's the relief for business, small business in particular, on that front going to come from, do you think?
Well, this is a good question, Ticky, because we need to see how government reacts in terms of regulations on banks and lending institutions, and then we need to see how they respond to that. Certainly the signs that we have seen is that the banks are certainly tightening their credit, and there's sort of almost zero growth in business lending out there at the moment, and there's a lot of businesses reporting, particularly small businesses where the house is on the line, they're reporting that access to capital is becoming very difficult, so they're trying to find other sources of funds, which is not particularly easy because it impacts on business models. So we need to be very careful about an overreaction to the Royal Commission. But the impact has already been pretty tough. We're seeing insolvencies across retail, hospitality, construction, transport, all on the increase in recent times because those sort of businesses are being squeezed. They're suffering from margin squeeze, and we're seeing real pressure being put on them. And
what about input costs? I mean, and particularly power. What do you think of this new energy spend by the government on expanding the ERF? Snowy 2.0 confirmed. Tasmania being the first, hydro being the first underwritten project from the Energy Minister. Is this cash splash the right thing to do?
Well, look, what business has been crying out for a long time is long-term policy certainty and policy coherence here, and we've welcomed the two measures, in particular around the Snowy and around the emissions fund that the government has established, that the government has refunded, because they're both positive in their own way, but there's still a lack of coherence at a federal level. And at a federal and state level around energy prices. So, Ticky, if you think that, think back this way, electricity prices for manufacturers in Australia have gone up 84% on average since 2010, and gas prices for manufacturers are up about 45% since 2010. And some of the bigger energy users have had increases much more than that. But on average, that is telling us that these input costs are really hurting, and in all the data we're getting back from industry, those input costs, particularly around energy, are very difficult to pass on. Manufacturing prices in that time since 2010 have only gone up 19%. Yep. And so that is really squeezing business. So, look, what we want is long-term sort of certainty for business. There's not a boardroom in the country that isn't talking about energy prices and about carbon emissions and the role that business can play in that.
OK, well,
and to think otherwise is fooling yourself.
To that point, I was really interested that in New South Wales, Michael Daly, Labor opposition leader, was up in Coonamble near Narrabri, which is Santos's big gas project. He'd like to get off the ground. It looks as though there's going to be a big standoff, maybe not before the state election, but after the state election. Tensions with manufacturers like Qenos and others. How do you see this sort of battle playing playing out for the hearts and minds of ordinary Australians?
Well, the fact is, Ticky, is that ordinary Australians are complaining about their own costs in their households going up, and a big one is energy cost. And then you have to go back and work out, well, why is that? And that's because supply is a significant issue, and reliability is also a significant issue. So households are paying for the lack of action around energy that we've seen, lack of coherent action, or sometimes an overaction from government and interference in a market from government. And look, we have to resolve this tension. And we've seen the Northern Territory government agree to push ahead with fracking on the one hand. We've seen some action down in Victoria in terms of offshore. You look at a state like New South Wales, which imports 95% of its energy. That's just not sustainable in the long term. So states have to take the bit between their teeth, have a good discussion with industry of all sizes, the producers of energy and the users of energy, and farmers and regions, and work out a long-term solution here. Yep, it's not easy. Everyone knows that. It's tough, but it's got to be done, or else we're just going to go into a death spiral.
So really interesting. You mentioned that emissions are, big discussion around boardrooms as well. Now, gas obviously a fossil fuel, but it's not the sort of devil that coal is rapidly becoming at the moment. Now, you're obviously on the board of Aussie Super, which was one of the funds that joined in the Climate Action 100 Plus group to put pressure on Glencore very successfully to halt their production of new coal. Now, where do you think the pressure will go next? And is this the end of investment in new coal?
Well, I can't talk for Aussie Super because I'm not in management, but I sit on the board. But they are part of a international collective of institutional type investors who are looking around long-term certainty in this sort of policy area. Look, we've said at AI Group for a long time that there's no issue with coal in terms of our members utilising energy sources. Our members are agnostic about it. The fact is that you're just not going to get that institutional investment in coal that you would have maybe 20, 30 years ago. And we're getting to the point where we're in Australia, at least, our coal-fired power plants are getting old and they're getting rickety. And if we're not going to replace coal, we need to find other sources of baseload power. And that's where the conversation around less emissions intensity is really important. There are different ways of doing that. Gas is one way. It's less emissions intensive. There's renewables and a whole range of renewables there. Yes. But we need to get the balance right. Okay. And look, Glencore made its own decision, Ticky, after talking to investors, and I can't talk for them either.
Righto. All right, more broadly on governance, particularly within industry super as a sector, Ines, because we're seeing the latest numbers from APRA. The flow of funds into industry super is continuing as a result of Hayne largely. But where do you sit now? Because you're on the record at saying retirement incomes of millions of Australians must not become an ideological plaything when we talk about boards being influenced. Where do we sit now on the pressure to increase wages and the pressure on industry super funds generally to work to increase wages and indeed keep jobs, which may be at the expense of companies who are actually looking at very difficult decisions on the investment front?
So there's a couple of parts to those questions. First thing was there was an attempt by the ACTU last week to sort of revive an idea that they've kicked around for a while now, that industry super funds and super funds more generally should use their investment might to influence industrial relations outcomes. I'll just make that clear. That is just not going to happen.
That's not going to happen.
Not going to happen. It is totally against the remit of industry super funds. So, I mean,
well,
I'll
particularly
just put
after
a line
Hayne.
not under it. I'll put a line through it. It will not happen, and we will not allow that to happen. So that's one thing. The second thing is that funds make investments in their members' interests, and in Australian Super's case, that's over 2 million people. We're seeing an increase in membership since the Hayne Royal Commission. We've seen a significant inflow of funds into our fund, at least after Hayne. We need to manage that carefully and make investments that are in the members' interests across the range of investments that we can make and across the range of vehicles at our disposal. But we do have a role in a whole range of different areas, and we understand that, around making Australia a better place. It's a better place to work, so that's investments in Australian businesses or businesses that relate to Australia in a significant way. We're looking at things like venture capital funding for small businesses and startups. We're looking at things like social housing, which is a big need in the community. But we have a role to help drive the growth of the country. And look, I think we should put our hands up here and say we've got 5% unemployment, 4.5% unemployment in Melbourne and Sydney, and 6% around the rest of the country. But so we have different labour markets, but we're getting to the point in the whole of full employment. We saw manufacturing put on 75,000 jobs last year. It's back up to 1 million people being employed. Mining put on about 35,000 jobs, so they're about 250,000.
But what's happened to the Phillips curves? Where's the wages increase?
Well, where I was getting to that was where the most of the profit growth in recent times, 70% in some years of the profit growth has been in mining and in finance, and between the two of them, they only employ 6% of the workforce. So the big parts of the labour market in Australia, where the labour market is, aren't seeing that profit growth and aren't then able to see wages increase. Now, I'll put that to one side. We've seen wages increase in construction by almost 6% over the past year. Data is out saying wages are up 2.3% for the last quarter of last year compared to 1.8% 2 years ago. So we are seeing some wages growth come through. Part of the problem is that we are nearly at full employment, and so that in itself is attracting people into work, and there isn't sort of the demand, as it were, for significant wage growth across the economy when we've got low productivity and the like. So
right.
I think we're going to continue to be in a period of sort of restrained wage growth, which is keeping up with inflation, I have to say.
Ines Willox, always great to talk. Thank you very much.
Thanks, Ticky.
And I should just note that Rio Tinto's results look like dropping about 5 o'clock, so in about 12 minutes. Stick around for that. After the break, Craig Scroggie, CEO of NextDC, on the company's half-yearly results.
You're watching Ticky on Your Money.
Welcome back. Well, NextDC posted a half-year loss of $3 million and lowered its full-year guidance, down from $8.4 million profit recorded in the same period last year. Operating cash flows were down in the first half by 44%, but management says the company is still well capitalised for growth. Revenues lifted 17% to $90.8 million in the first half, but revenue guidance has been lowered to between $180 and $184 million. For more on those results, Your Money's Chief Business Reporter Leo Shanahan spoke with CEO Craig Scroggie a little earlier.
Craig Scroggie, thanks so much for joining us.
Great.
Now, look, some good results today, actually. The market's not rewarded you, though. What's going on there, do you think?
Look, when the company always posts very, very strong growth year on year, another record half for us, record revenue half, record new sales half. Expectations are always high, so it's just, tend to not pay too much attention to the share price. It goes up and down.
Yeah.
We control what we can influence, and that's the performance of the company, and this is a great result.
Now, revenue up 17% to over $90 million. That's pretty impressive. What's driving that at the moment?
Yeah, well, obviously the continued growth, data centre services growth was more than 23% year on year. The thing that's interesting, obviously, is that we continue to get really strong growth in the adoption of cloud computing. So whether you're a consumer using Facebook or Twitter, in a business context using LinkedIn for networking, the amount of information that we're creating and sharing online is at a record high. And that continues to drive both consumer enterprise computing and business-to-business computing.
Now, there has been talk of limiting capacity in your market, in what you do, in data centres. Are you concerned that Sydney, Melbourne, and the big cities where you are have hit capacity there, or do you see increased growth?
Yeah, look, there's a huge amount of growth really yet to come. We're just starting to scratch the surface of the growth of the digital economy largely. Consumer services right through to the enterprise. So both public and private cloud computing. We're seeing billions invested from the big global players like Microsoft and Amazon and Google. Those billions are going into creating more business and consumer services. We're downloading more videos, we're watching more Netflix, we're creating more and sharing it than any other time in history. And that's fueling an enormous amount of growth that's reflected in our growth numbers. Our biggest challenge today is really keeping up with that rate of growth and building. We try and keep our capital that's deployed to build data centres to support these computers as tightly aligned to that demand as we can. But at the moment, the market is at a historical high, and we're doing everything we can to keep up with the growth.
Now, you had a resolution later last year with your property trust, or the property trust which owned a lot of the buildings, basically. You must be happy with that. Yeah,
when we, back very early on in the company's history, we sold the underlying land and buildings. We created a REIT called Asia Pacific Data Centres. We had to recycle the capital at the time. We couldn't afford, as a startup and a growing company, we didn't have a lot of capital, so we sold the underlying land and buildings in order to continue to fund the hundreds of millions that were required to build the data centre platform right around Australia. Now the company, you fast forward 7 or 8 years, we're large enough, obviously, to afford to be able to bring those underlying land and buildings back in. So we acquired Asia Pacific Data Centres, and we've now fully consolidated back inside of NextDC.
Now, look, there was an article yesterday about Equinix, one of your global rivals, investing about $225 million in a new centre in Sydney. Firstly, your thoughts on that acquisition, and secondly, does that concern you, given their global role, capacity, to be a pretty good competitor? Yeah, sure. Look, we look at Equinix really as the gold standard benchmark for what being a leader in the retail data centre co-location industry looks like. They're an extraordinary company. They've built a $40 billion business over a decade and a half. So we think that they build a fantastic quality product and have a big global platform. We differentiate a little, so we've also very focused on building retail or enterprise co-location businesses. That means that we support big enterprises in Australia moving into a professional co-location facility like ours, and we help those enterprise companies then connect to the cloud. So if you want to take your infrastructure and then stitch it together with Microsoft and Amazon and Google or any other provider, you do that inside of our data centres. So, when we look at someone like Equinix's business model, the investment that they've made in Australia is just further evidence, another couple of $100 million there. Last year, they acquired a local company called Metronode for just over $1 billion. So we see that continued investment as just further evidence that there's a huge amount of growth yet to come in the industry. Yeah, well, speaking of Equinix and acquisitions, they are big old acquisitions. You think they'd have a pop at NextDC? Look, you leave the things outside of your control to the market. As long as we continue to run and build a great quality company, look, anyone can be interested in the business at any time. One thing that you do notice in data centres at the moment is that M&A activity is very, very active. It's a hot space. Data centres take a long time to build, and that's why ultimately they are very like a long-term infrastructure asset, and investors are very interested in that long-term revenue stream that comes with building a data centre platform. So, yeah, look, anything can happen, but right now we focus on what we can control, and that's building a great company. Sure. Now, tell us a bit about some of these customers, from retailers that are scaling up to some of the larger ones, the Googles, Facebooks of this world. Yeah. So we are a business that essentially focuses on two markets. We focus on retail or enterprise co-location. So that's serving companies like accounting firms and legal advisory services, so Ernst & Young or BDO,
or KPMG or Morgans, right through to your standard IT services companies, the HPs, DXCs, IBMs of the world. And then you go to the very, very big global cloud computing providers. So that's the Microsofts and the Amazons. This year, just recently, we announced that we've taken, not only do we support Microsoft and Amazon in the Sydney and Melbourne markets, the big cloud computing markets in Australia, but we recently took Microsoft and Amazon into the Perth market. So all those big West Australian enterprises can now directly connect to Microsoft and Amazon locally in our Perth data centre there. So we're seeing the combination of those two markets, the more money, the billions of dollars that gets invested in those cloud computing platforms means that you and I, as consumers, can access more internet services. They're cheaper, they're faster, they're more connected to the global platforms than they've ever been at any other point in time. And then small businesses right around Australia get access to those public and private cloud computing services as well. So we serve both ends of the market. Our go-to-market model is unique because we sell through partners. So Telstra and Optus, Vocus, those telecommunications companies are also very, very good partners of ours, and they sell their telecommunications services and they bundle them with the data centre. And we just recently announced a deal with Superloop, the telco, for the new submarine cable that's coming from Singapore to Perth and then going around to Sydney. So it's a hugely exciting
massive project.
Time. Yeah.
Now, with all the growth and good client base, you are nonetheless being shorted a fair bit at the moment. You've entered at one point some of the top 10 shorted stocks in Australia. Are you concerned about that?
Look, again, it tends to be one of those things that we don't spend a lot of time thinking about things that we can't control. Just like the long side of the market, the short side have a theory that they believe. In our case, they think the company obviously has a high valuation. We think it's a low valuation, so therefore we'll continue to focus on, hitting the ball out of the park, building great numbers and shooting the lights out. As long as we continue to do what we've committed to the market will do, I think we'll continue to get investor support. Now, there was some consternation, I'm not suggesting this is driving the shorters, that you personally are living too much of the high life, spending this money that you've earned well, but there was some consternation about your Instagram feed. Are you living too much of the high life? We're still working pretty hard. I still fly economy all over the world. I still caught the train here to see you today. Yeah. When we're spending the company's money, we spend it in a very, very disciplined fashion. From a personal point of view, my values haven't changed, and we focus ultimately on ensuring that when we invest shareholders' money, we invest it to get the very best return that we can. So I have a bit of a laugh, ultimately, when you're successful and the company's successful, you'll take a few knocks because people will want to bring you down a rung, but at the end of the day, we're disciplined and we're focused on building a great company. Yeah, from a broader technological viewpoint, there's so much talk about the cloud and companies moving to use in the cloud and individuals. How does that work for a company like yourself? Because from an outsider's perspective, your understanding is, well, the cloud cuts down on the basic machinery, the hardware, for lack of a better word, that you rely upon to make money from. So what kind of hurdles does the cloud present, or is it opportunities for you? It's an extraordinary opportunity. So if I use a couple of examples, so go back to Moore's Law, so the price performance doubling of integrated circuits, so 1967 or thereabouts, Gordon Moore wrote a white paper that talked about, had a log scale and said, over time, the number of transistors on a circuit will continue to double and the price will fall. Now, that was true for 50 years. And what that has meant is that we've got more computing capacity in a small amount of space at a lower price every year, year on year for 50 years. And now when you look at what you're carrying, the computing capacity you're carrying around in your pocket is unprecedented. Now that should continue to happen. There's a guy called Ray Kurzweil, the head of artificial intelligence at Google. Here's a thing called Kurzweil's law, which is technology built by technology drives an exponential rate of change. And what we're seeing now is computers building more computers. So we're getting more technology in a smaller space. The argument is it takes a little bit longer, but we're seeing massive advances in computing capability. So I think that we're really only just at the beginning of this massive transformation. It's generally referred to as the transition to the fourth industrial revolution or the cyber physical age. So we're massively excited. When we look at the data center, that physical reduction in space is a good thing. Density increases. Ultimately, our business model is driven on jamming more computers into a smaller amount of space over time. That is good for society. that is good for our business and ultimately good for our shareholders.
All right. Craig Scroggie, thanks so much for joining us. Fascinating stuff.
Great.
Now, still waiting on those Rio results coming up very shortly after the break. Insurance Council Australia Chair Richard Enthoven next.
This is Ticky on Your Money, covering the big business stories.
Yes, welcome back. Well, the Insurance Council of Australia held its annual forum in Sydney today, and unsurprisingly perhaps, a keynote address from ASIC Commissioner Shaun Hughes pulled no punches, talking through the Hayne Royal Commission and ASIC's priorities for insurance. On the Royal Commission, Hughes said, unfortunately, testimony in the Royal Commission provided a sobering snapshot of a serious disconnect between community expectations and consumer experiences. While the work that lies ahead may seem challenging, it is an effort that must be made. It's important to remember that these changes have one critical purpose: to rebuild community trust, and we all have a part to play. Well, going into the regulator's key priorities for 2019, the Commissioner said that ASIC will focus on court-based outcomes to provide strong public denunciation and punishment of wrongdoing. Pretty tough, isn't it? This tying into ASIC's continued crackdown on breach reporting. It will also be focusing on the inappropriate sales of consumer credit insurance, looking into fraud investigation practices used by insurance companies, and the continued reform of the General Insurance Code of Practice. Well, let's get the insurance industry's reaction to this. The chairman of the Insurance Council, Richard Enthoven, joins me live from our Sydney City studio. Richard, nice to see you there. Thanks for coming over, because I know you've just left the conference. It's fair to say that you're under more scrutiny than at any time since the HIH collapse?
I think that's fair, but we're also really excited because Justice Hayne has done his work, he's issued his report, and we now have a clear roadmap for the changes that the community needs to make and the industry needs to make to rebuild our customers' trust. And I can tell you the industry is really excited about that opportunity.
How are you going to balance, I mean, some of the tough recommendations which require that you redress your standards as far as the community is concerned, with the fact that insurance, by definition, and the offers to the community have to be sort of living documents, don't they?
Yes, they do, and the Insurance Council and the industry will engage closely with all the stakeholders to ensure that the regulatory outcomes that we get give customers the protection that Justice Hayne has been looking for, but also keep insurance available and affordable, because that's really important. Our products have an enormous social good embedded in them, and we don't want to do anything that undermines the availability and affordability of insurance.
Richard, can I ask you about the general insurance in particular, which obviously has had a roller coaster of a year anyway with all natural disasters and everything, but the code of practice, which I think is going to go from voluntary to mandatory, how can that work going forward? And because the enforcement around it is going to be much tougher, but I suppose at least Kenneth Hayne accepted that you could start there with the code.
Yeah, so we've had a code of practice as the general insurance industry for a long time, and the Insurance Council has been working on a revised code. We've engaged community groups, we've engaged regulators, we've engaged stakeholders, and we're confident that we will come out with a revised code of practice that can get ASIC approval and that our members will honour and comply with. So we think it's a great opportunity for the industry to get on a firm footing and to move forward in a positive way.
Are you going to be pushing for sort of regulatory impact statements going forward? We've just seen the flip that Labor has had to do around the mortgage brokers' recommendation, this idea of customers paying up front. And they were just going to accept it to start with whole hog, and then everybody sort of realised what the knock-on effect was for that particular market. One of the things, as I understand it, the insurance industry worries about is that people make changes, but again, it has a knock-on effect. How are you going to go with these regulatory impact statements?
Well, we're keen to make sure that all stakeholders understand the unintended consequences of any potential change to insurance regulation. And what we are effectively doing, following Justice Hayne's recommendations, is ensuring that the really adverse outcomes, and there were, in the general insurance space, just a handful of isolated adverse outcomes, that we eliminate those, because none of us in the industry felt proud of those. But it's also really important to remember that the vast majority of our customers are satisfied, their claims are paid, and we need to make sure that we don't do anything to make insurance more expensive or even unavailable for those people.
Yeah. Richard, I mean, you say it's isolated incidences, but, and Kenneth Hayne did acknowledge, I think, that it wasn't systemic as perhaps things were culturally in other parts. Nevertheless, we've seen these terrible examples paraded through the Royal Commission, whether it's funeral insurance or other sort of types of insurance. Are these people going to be brought to account through the courts in the usual way, do you think?
Well, that's not really a question for me. That's a question for the regulators. What I can say is the industry is absolutely committed to learning the lessons of the past. We acknowledge the mistakes that we've made, and we will work tirelessly to come up with a new framework that helps us rebuild the community's trust. And I should just note that we are, as we speak, dealing with two huge catastrophes, the Sydney hailstorm and the Townsville flood. And thousands of insurance operatives are scattered around the country helping our customers when they need us most.
Yeah, I want to move to that because obviously that has had a huge hit to your numbers in the industry. What sort of an impact is that actually going to have on premium going forward? In fact, the whole idea that climate change around the world is changing the base case now.
Yeah, so individual companies will make their own pricing decisions, but clearly if weather patterns are changing, and I believe they are, then and those changes in weather patterns are causing more natural disasters that will directly result in higher premiums for customers. So the consequences of climate change are real, they are current, and they have a profound impact for our customers and our shareholders.
Yeah. And what about one of the things as a result of Hayne, of course, is that people were expecting vertical integration possibly to be banned. There's been a lot of sell-off of insurance assets by financial institutions. Many of them have gone abroad. Are there types of insurance stroke reinsurance that just it's too hard to do in Australia now?
No, I don't think so. Specifically not general insurance. The general insurance industry is still dominated by Australian companies. Yes. And the market continues to grow and the companies continue to innovate and are very competitive on a global scale. So I'm confident that our industry will continue to thrive, it will continue to grow, and it will continue to serve our customers. And we will work with the community to reduce adverse customer outcomes.
And the whole idea of conflict of interest, the hawking of extra services, all those issues that Kenneth Hayne was very concerned about. Was there a lot of talk about it today?
Yes, there was. And I think the general sense is we're all in agreement with the spirit of what he's saying, but we need to make sure that when we actually write the legislation, there's nothing in the detail which has unintended consequences.
Yeah. But it's got to fix both things, because if it doesn't fix this, and it is endemic everywhere, this conflict of interest problem to the satisfaction of the public, we haven't progressed at all, have we?
Yeah, that's right. Although there's nothing in Justice Hayne's report that suggests there's any unnatural conflicts of interest in the insurance broker landscape. So I think we need to be careful that we don't create a industry-wide solution that might work for some parts of the financial services industry but not others.
Yeah. Well, Richard Enthoven, I really appreciate you coming over. It's a really interesting and important space, lots of moving parts, so thanks so much for joining us.
You're most welcome. Thank you for having me.
All right, now those Rio Tinto results have just dropped while I was talking to Richard. Rio Tinto posting full-year underlying earnings of $8.8 billion, up from over 8.6 last year, slightly higher than market expectations. The company also posting a final dividend of $1.80 US a share, plus a special dividend of $2.43 US a share. The miner says 2019 production guidance is unchanged from its fourth quarter operations review. Well, that's pretty interesting, isn't it? Well, earlier this month, Yi Jiang, a 23-year-old Chinese national, pleaded guilty to stealing customer information from AMP while working as an IT contractor. He was caught downloading passport and licence details of 20 customers in December, then downloaded a dark web server allegedly to sell the information. But Zhang had been detected by internal AMP security and was blocked from their systems before being arrested at Sydney Airport in January on his way out of the country. The company decided that detected Zhang at AMP was Dtex Systems, an IT security operator founded by Australian Mohan Koo, now operating in the US. Well, he spoke with Your Money Chief Business Reporter Leo Shanahan to discuss the investigation, the threats posed to companies by private and state actors, especially in China.
Mohan Koo, thanks so much for joining us.
Thank you.
Now, look, I'm interested in firstly talking about this incident at AMP that you were involved in late last year and early this year. What took place and what was the role of your company, Dtex, in that?
Obviously, given the sensitive nature of the incident, I can only really disclose what's already in the public domain. So basically, we helped to detect and discover a foreign national working at AMP who had tried to steal some sensitive data, and he was subsequently picked up at the border and stopped on his way out of the country. A couple of weeks ago, he pled guilty in court, so a very successful situation in terms of AMP's ability to be proactive in the cybersecurity landscape, which is unfortunately not a common situation for a lot of organisations out there, and certainly given that the New South Wales Police and the Australian Federal Police commended AMP cybersecurity team for their efforts. They did a very, very good job, and they had a very sophisticated cybersecurity posture at AMP with some technology, and Dtex plays a role in that platform to be able to detect unusual behaviours or bad behaviours at scale for an organisation. So organisations like AMP and other large organisations don't have the ability to have lots of eyes on glass to be able to see everything that's happening with sensitive and classified and customer data. So it's important to have sophisticated technology that can run analytics against data and see things that's happening at scale across an organisation that has many, many thousands of employees touching all kinds of sensitive customer data, and be able to detect that in real time so that you can catch the horse before it bolts. And in this particular case, that was the situation.
So what kind of behaviour was picked up in this instance? What kind of behaviour by this employee was picked up, and what kind of information were they trying to take with them?
So as was mentioned in the news a couple of weeks ago, there was access to Australian driver's licences and passport records from some of AMP's customers. So highly sensitive data that really shouldn't be leaving the organisation unless it's leaving for authorised purposes. And clearly this particular individual was doing things with that data that they shouldn't be, and was unusual for somebody in their role.
Yeah, was it odd, do you think, that this, from what I understand, was passport and driver's licence information? Was this being sold? Was the plan to on-sell this on the dark web? Would that actually even be a particularly profitable exercise? What do you think was going on here?
So I really can't comment on what was the intent, but what I can say is across a number of organisations in Australia, as well as in the US actually and the UK, where we operate with a number of big brand organisations, particularly financial services and government organisations, we are starting to see a much more coordinated attempt by foreign nationals to get data out. In the days gone by, you know, we would see people trying to get access to sensitive data in order to sell it on the dark web and make personal financial gain. But it certainly seems now that that the coordinated attempts by several foreign nationals are indicating that it's more organised than it used to be, and perhaps not just focused on personal financial gain. So it leaves the mind questioning, you know, what else could it be?
Now, in this instance, it was a Chinese national. Is there any indication from your end that this had anything to do with Chinese, well, basically any kind of national security issue, any spying, basically, that was going on?
So we have no ability to comment on that, but what I can say is, as mentioned, you know, it's starting to become more coordinated, and they are targeting specific types of data. So the landscape is definitely changing. Let's just say that, and you know, when you start to see more coordinated efforts, it does leave the mind questioning. You know, where is this going? Who's organising it? Who's coordinating it behind the scenes? But what I can definitely say is as organisations get much better at protecting their perimeter, a lot of companies around the world, big brand organisations and government departments, have become much more protective about their cybersecurity perimeters, and they have been very, very good at catching malware attempts and infiltration through malware. But what happens is, as customers get and big organisations get much better at protecting against malware and external attacks, what's actually happening is the insider becomes a much bigger issue, as we've seen in this case and many others recently. It's far easier to actually pay somebody on the inside or coerce them in some way, shape or form to get the data that you're looking for, rather than finding a needle in a haystack. When you're a hacker, you still have to get through the network, into the network, and then once you do, you have to find what you're looking for. Whereas if you pay an insider, they already know where it is, they know how to get it, and in some cases they actually know what security controls are in place that they need to circumvent and navigate. So, you know, again, having the analytics to be able to detect unusual behaviours and ways that people are getting smarter at getting around cybersecurity systems and controls is absolutely paramount for organisations today.
So these groups, whether they're state-backed or not, tend to be using tactics that classically are used by espionage by state actors, that is, to pay individuals, to get on the inside, perhaps even to blackmail people working within big corporations?
Certainly, we've seen many cases like that, and as I said, an increasing number of cases. And unfortunately today, a lot of people put their information out in social media. You know, people often think about what they're putting on Facebook, etc. But LinkedIn is a very rich source of information about people on the inside and who they're connected to and what they do in terms of job role, etc., etc. So it's now relatively easy for outsiders to be able to trawl the internet and find out information about insiders inside organisations, and, you know, try and pick the ones that might be able to get to the crown jewels easiest, or might have some kind of a personal issue which would lead them to do things for personal financial gain, and are very easy to take advantage of those people in situations like that.
What about the role of China as a state here? Obviously, it's not clear what's gone on in this instance, but broadly speaking, there's a lot of concern about Chinese intelligence and espionage against private organisations, companies looking for IP, but perhaps other types of information. What's your view on the role of China in this at the moment?
Well, I would say, you know, it would be pretty naive for anybody to think at this point in time, and in the way that everybody's using technology, it would be pretty naive to think that most governments are not using access to the internet to take advantage of other countries and situations like that. But certainly, with the number of Chinese nationals that are now operating and working inside Australian businesses and government, universities as well, you know, there is some cause for concern, and I guess, you know, if we have the right cybersecurity controls in place, if we have the right levels of monitoring, non-intrusive monitoring that's not unnecessarily invading people's privacy, and we're using analytics to be able to see and detect bad behaviours rather than just straight out running surveillance on everybody, then we're in a good position to be able to control that situation and not unnecessarily blame anyone, but react very quickly, as AMP did in this particular case.
All right, Mohan Koo, this is fascinating stuff, and we'll talk again soon. Thanks so much for joining us.
Thank you very much.
And after the break, we'll go through today's results, including from Rio Tinto, with Steve Johnson from Forager Funds. Welcome back. Rio Tinto posting the $8.8 billion in underlying earnings for the full year. Let's go for some analysis with Steve Johnson, CIO of Forager Funds, who joins me live at the desk. Steve, what do you think?
Good numbers from Rio, and I think good numbers from quite a few of the large caps on the ASX, and I think there's some sensible prices out there for some of those businesses as well. While there's so much noise around some of these growing tech stocks, there's some good businesses there, lots of cash, lots of capital being returned to shareholders as well, which I think is positive.
Well, a special dividend from Rio as well, and I suppose their production numbers guidance was the same for 2019. It's going to be careful about how much iron ore it puts out, but it's really riding this iron ore and copper.
Absolutely, and I think the whole industry is still being very disciplined at the moment in terms of adding new supply. So as long as that remains the case, you would imagine businesses like Rio and BHP that are at the low end of the cost curve are going to keep spewing out cash, and that so far they seem to be keeping their discipline themselves as well, which I think is very positive for shareholders.
And of course they've laid off coal largely to Glencore recently, and that seems to have worked for them as well in terms of the sort of investor that they're trying to attract. Yeah,
I think interestingly at the moment coal is still a very good asset to own from a cash flow perspective, and it's going to be very interesting I think over the next decade to see how this debate unfolds. I'm not sure that divesting coal assets, and you've seen all the commentary from Rio Tinto today about how they're thinking about these issues and how they're managing them and how they're trying to reduce their own outputs. I'm not sure that those assets being divested and in the hands of potentially owners who care less about it is actually going to help the long-term output. So there's a lot of noise in the space at the moment, and I think it needs a lot of consideration from people about how to actually achieve the outcomes we want, which is less carbon output.
Well, right, as everybody fights for that investment dollar. Now, I should ask you about milk. There's the most extraordinary difference. We've had Bellamy's and Murray Goulburn today, really worried about things, and yet A2 Milk, Jane Herdlicker seemed to sail through her result. Yeah, absolutely. I mean, that business has absolutely astonished me. I have to say I was sceptical 3 or 4 years ago, and it has grown and profitably grown for extraordinarily over that period of time, and it's kept going when some of these other brands... I think the risk around all of it is it's a fad, and with the Chinese consumer that they love something one year and they don't the next, but so far A2 is the one that's been able to entrench its brand more and compete, and you are seeing more competition coming there, especially from the European milk producers creating their own sense of a high-quality product, but A2's been able to carve out this niche and do very well in it. Steve Johnson, we'll have to leave it there. I'm sorry, a very tight show tonight. Thank you so much for coming in. Thanks, Ticky. Well, that's all for the show tonight. Tomorrow night, Loftus Peak CEO Alex Pollock. Thank you for your company.